A warm welcome to all participants. Thank you for joining us on this edition of Market Talks webinar series. Today we are delighted to have with us Daniel Lacalle, Chief Economist at Tresis. Daniel, thank you for being with us today.
Thank you so much. It's a great pleasure to be here.
Okay, before we begin, just a brief reminder on the fact that you can submit your questions on the Q&A icon on your app. And with further ado, we move into the first of the topics, the elephant in the room, AI, and how AI is shaping not only financial markets, but also the economy and broad macro. We have now committed investments on AI infrastructure that are adding up to 2% of US GDP. So the question to you, Daniel, what is, in your view, how can AI affect the main macroeconomic variables and broadly financial markets?
Thank you very much. I think that the importance of AI is huge because it is not only a very relevant factor of GDP growth. If we look at the estimates for 2026 and 2027, the only economy in the G7 that is going to grow significantly is the United States. Canada, France, United Kingdom, Japan, and Germany and Italy all are either in stagnation or in recession. So those elements are very important when we look at, for example, how the United States is going to be growing at a 2.5, 2.7% annualized rate. But it's not just GDP. In terms of productivity growth, in terms of attraction of investment, in terms of the opportunities that artificial intelligence generates for small and medium enterprises, it's also a huge boost that is going to massively help, for example, the logistics sector, the exporting sector that face significant challenges of working capital. No? So all in all, those countries that are investing significantly in artificial intelligence and applying it radically into the productive system are finding themselves in a very significant difference in terms of comparison with the peers in their group. And for financial markets, artificial intelligence is enormous. No? I think that it's going to be one of the drivers of improvement in margins, improvement in productivity for many of the sectors that have found themselves with a problem of overcapacity, with the challenges of managing supply chains. That is going to be phenomenal for many of these sectors. So it's not just the boost that it generates to equity markets like the Nasdaq, which is very evident because of the leadership of the US technology giants, but it's also going to be a driver of improvement of margins and therefore earnings estimates for many of the companies that have lagged in recent years in a period of manufacturing weakness and in a period of working capital challenges. So all in all, I see that it's a big revolution that is in its infancy, and that is going to generate quite a significant boost in the next 5 to 6 years. And there will be a very significant difference of valuation and multiple expansion for the names in the equity market that have taken the advantage and adopted artificial intelligence strongly relative to those names that don't. No, so I think that there's going to be a lot for analysts to discuss in terms of granularity and check who wins and who is actually lagging in this revolution.
So if I hear you well, you are saying this is a tide that will lift all the boats. So companies are going to profit from productivity improvements, lower costs, probably also a lot of innovation happening, which will hit on the top line of the P&L. There is also for us as practitioners in portfolio management the question of how much diversification is adding at the moment. We say now diversification is becoming an active bet because not being invested in this, you mentioned before, this big dispersion in in earnings and in those that are leading the charge on AI versus the rest, it's making or turning very, very difficult to apply the rule book of investment of investing, right? Saying, well, you diversify and it will all be fine. It's the free lunch. Now it's a real active bet to decide to allocate broadly. But I agree with you that this is going to be overall positive for, I mean, for the market as a whole. What about the macroeconomic variables? Because you mentioned productivity. Productivity comes usually with a delay from the time you start investing. We are seeing these huge amounts of capital deployed into data centers and so on. We don't see the productivity of showing in the numbers that happened already with the previous digital waves that we had. Typically, there's a time lag of 5-10 years, but this is a very radical and different technology. So how do you see productivity, inflation, and we will save interest rates for later because we have a question for that.
In terms of productivity, the gains in productivity and the improvement coming from artificial intelligence are much, much, much faster than other technology revolutions that we have looked or witnessed in the past. It's a huge difference. When you look at countries like South Korea and you see how artificial intelligence is shaping, for example, the shipping sector for anything from retail to the most traditional manufacturing parts of the economy, what you can see is that the impact is very broad, very quick when the countries adopt artificial intelligence quickly. A lot of people tend to question the risk of artificial intelligence as being a driver of labor force reduction. But if we look at the countries that have adopted artificial intelligence in a very significant way, what we can see is that it does not reduce employment. In fact, it does not even have an impact on jobs in the so-called low risk or low productivity sectors. In fact, it generates more. No? So I think that in general, what we can expect is that the period from investment to adoption and visibility in earnings and in margins is going to be very, very short. And when I mean short is that you can see, for example, you've seen companies in many of the Asian economies that from the period of adoption to the manifestation in earnings of the improvement, you get less than a year, 3 quarters, no?
Yeah, that can be also very positive for equity markets because now there is this uncertainty on how much this technology will help earnings, and if this transition is shorter, definitely we could see it earlier. So thank you. Let's move into the next topic. It has to do with economic cycles. You touched upon labor. Typically, we have had longer and longer economic cycles. So we have to come back to 1991 in the US to have the latest business cycle recession. We had the cycles ended for reasons other than business cycles. So in the 2001 was the dot-com bubble, in 2008 the financial crisis, and 2020 was a pandemic. So now we are in year 5 of this cycle already after 2020. So a question for you: how long you think this cycle still will go on?
I think that this cycle is very different, no? Because we are living in a K-shaped economy. We have sectors that are booming, in which economic growth, earnings growth, and resilience in terms of volumes and sales are phenomenal, and other sectors that have barely recovered from the 2020 crisis. No, so I think that is why this cycle is so difficult to predict. Is that it's not moving in the same way that it did in 2001 or in 2008, and it also shows why, for example, the equity market is so differentiated, and there's such a disparity between those names that have outperformed and the names that have actually lagged the indices. No, we have seen, for example, how concentration is at an all-time high. That is typical of a K-shaped recovery. No, so what I think is that that's why we need to be, as you said prior, very active and very, very selective about our investments, because we need to be very concerned about those names that have not been able to sustain margins, those names that have lagged behind, and we have to be looking at those companies that are going to benefit from the next 2 to 3 years. Why I think that this cycle is also different, because what happened in 2020 was very different from other monetary expansion periods. In 2020, there was this massive monetary expansion from central banks, money supply growth rising above 27, 28%. We saw interest rates go into negative all over the world, absolute massive monetary expansion. However, what happened was that the private sector, most of the industries, instead of using that monetary expansion to invest more, undertake inorganic M&A, that kind of thing, what they actually did was to be massively prudent. No, that is precisely the reason why this cycle, I believe, is going to last longer, because what we have not seen is a flood of capital moving to malinvestment or to aggressive M&A, etc., in a period of exceedingly low rates. No, I think that is what will likely drive the cycle further. Also, because 2025 is actually a year in which we are seeing a lot of economies that are starting to see some recovery in manufacturing. Services is continuing to be strong. But it's interesting, because if we look back, 2023, 2022 were actually low cycle periods in terms of macroeconomic indicators for most of the private sector. I called it the private sector recession. No, there was a very, very weak environment for small and medium enterprises, a very, very weak environment in terms of productivity growth and capital expenditure. So I think that the cycle may be prolonged precisely because the different variables that have allowed the cycle to extend itself have moved in different moments.
I agree that we narrowly escaped the recession in 2022, 2023. I think there is you mentioned investments. Another encouraging sign is that the investment component of GDP is increasing because of all the this wave of investment in AI infrastructure. That's already another tailwind. I would say also we have an expansive monetary policy now, which we didn't have a year ago. We will come to that in the next topic. And from a fiscal perspective, we are still in an expansionary mode. So this cycle, barring any accident, should have still some legs to go. Yeah. So let's just dive into interest rates. You mentioned before the how much liquidity was created over the past years. The Fed has been reducing the balance sheet, has been increasing rates, and then finally started to cut interest rates. And you did, in your introduction also, you mentioned the era of low interest rates, even negative interest rates. For years, we were discussing about the say the natural rate of interest, this kind of say where monetary policy should be neutral. It was supposed to be very low. Then, for a number of reasons, demographics, technology, globalization, some of these reasons have changed a bit, but not much. Then we had the pandemic, and after the pandemic, we are talking about interest rates stabilizing eventually at a higher level. The Fed will eventually cut interest rates next week, but and is expected over 1% over the next year. But where will interest rate land from the point of view of the Fed, and where do you think interest rates will stabilize in the long end? In this, is a new regime or is going back to pre-pandemic?
I think we are slowly going back to the pre-pandemic level of rates that are slightly below the neutral level. No? If you think about the fiscal challenges of Japan, the United Kingdom, France, all these countries, it is virtually impossible for central banks to maintain a hawkish stance. Central banks cannot print any money that the governments have not spent before. No? So if we look at all of those fiscal challenges, usually what happens is that with a 1 year and a half lag, central banks need to become significantly more dovish. No? So I think that on the one hand, in 2026, we are likely to have yet another year of divergence. We'll likely see the Federal Reserve continuing to cut rates and bring them down to the neutral level. It is basically above around 75 basis points to 80 basis points above the neutral level right now. And the Federal Reserve will likely start a period of liquidity injections that don't increase the balance sheet. So basically, as they have already announced, delay in the process of normalization of the balance sheet, which in essence is a hidden backdoor quantitative easing of around 20 billion a month. So the Fed is a lot more dovish, I think. It's likely to be a lot more dovish in 2026 because it was way too hawkish in 2025. The ECB is on a wait and see mode. I think that is all basically going to boil down to how the experiment of re-leveraging of Germany and the fiscal consolidation of France are likely to move to. So it's a bit of an uncharted territory. I was yesterday for a brief couple of minutes with Christine Lagarde, and she was basically saying that they need to really monitor a number of things that include the level of inflationary pressures in the euro area, which are expected to be very low, and that could lead to 25 basis points cut in 2026. But more looking at whether the environment of economic growth, whether the environment of money supply growth, whether credit expansion remains relatively in line. So I think that Bank of Japan, Bank of England are going to remain very, very accommodative. I think that the ECB is going to be on a wait and see mode until probably March, maybe May. And in the meantime, the Federal Reserve is likely to catch up to these central banks that were actually very, very quick in the past year, while the Federal Reserve took a more cautious stance predicated on their view of the risk of tariffs.
Yeah, there is a further divergence you mentioned between the ECB and the Fed. In Europe, still unemployment is at all-time lows. In the US, despite being at a very low level, it's slowly increasing. So we are like 1 full point above the level we had a year ago. So yeah, there is surprisingly less urgency on the ECB side. Let's say. I have the most difficult question on interest rates for you at the end. That is looking further on, say, in 5 years' time, talking again about AI. We are concerned that we may have some bottlenecks appearing in energy. We have on rare earth minerals, everything that has to do with the construction and the powering of AI may become very scarce. What's your view on how this could shape inflation and monetary policy down the road?
I'm actually quite bullish because there's a great thing is that rare earths are not that rare. It's just a question of developing them. This is one of the myths, no? That they're limited to a few countries that are likely to be the ones that have the monopoly, like the shale gas revolution, like the North Sea revolution, like the mini nuclear revolution that we're living right now. When you start to see the early signals of scarcity or risk of scarcity, the alternatives appear very, very quickly. Right now, it is true that a lot of companies are not thinking about developing the rare earth potential of their nations because of regulatory burdens, mostly, not because of the lack of opportunity in capital expenditure. But I can guarantee you that the moment that we have this year, for example, copper has started the year very, very strongly, rising 27, 28%. People were expecting that copper would go up 50, 60% because of the enormous demand from electric vehicles and the energy transition. And it ended up falling down very and still up on the year, but losing a lot of the momentum as investors started to bring supply back into the market. No, so I think that that is likely to happen as well with the requirements of energy, of artificial intelligence. We are. I remember when the shale gas revolution started, how a lot of people were saying the United States is never going to reach 13 million barrels a day of production because of the enormous requirement of water. Engineers come up with solutions, and now you don't need even a fraction of the water that you required in 2007, and the production in the United States is at 13.8 million barrels a day. So if that example helps, the same thing happens with rare earths, with lithium, with copper. It's not a problem of availability of natural resources. It's a problem of, let's say, legislation and investment opportunities provided by nations. And I think that that is going to rise quite quickly. So I think that in the next 5 years, the likelihood of monetary policy is going to be more looking at a period in which the level of inflation is low rather than an inflationary burst. I don't think that that is going to lead to an inflationary burst. And we also must remember that commodities play an important but very, very limited effect on monetary policy, because most central banks look at core prices. So, even if you've had, for example, the big rally of copper, and when you had in 2008 the big rally of oil, monetary policy tends to look a little bit ahead, and what we tend to see afterwards is that the impact on overall inflation is relatively limited. So I'm actually quite bullish. I think that the concerns right now about availability or scarcity of natural resources are going to lead to the solutions that will demand less of those natural resources to be used to develop the technology requirements.
Yeah, you brought a very important point on prices of commodities versus prices of services, right? So normally the latter will be less affected. We have in 2022, actually, we had one instance of bottlenecks and energy prices spiking that translated into the service sector of the economy, and we are still suffering from that. Once you reach the service sector, it takes time to come down. Probably will be a question of how fast. I mean, it's like good and bad. Maybe AI will, if it improves exponentially, that and the incentives to develop it at a very fast pace create bottlenecks, you will be also probably having some good outcomes from AI in terms of productivity. So it is very tricky. It's a very particular situation, but I agree. Investors, I mean, we are here to also tell to our clients a bit what is coming. I agree that it should not be a topic for next year, at least. I mean, we will see how much the supply side fixes in advance this potential demand that will come. You mentioned also the shale gas revolution in the US. The next topic is about the US exceptionalism and how much, whether it's still there. Definitely, there will be different competitive situations in terms of access to energy and countries that are better and worse positioned. But I wanted to bring the topic of the US versus Europe. This is one year where, Europe and the rest of the world compared to the US in terms of equity markets have outperformed, which is a rarity over the last, say, 15 years. Liberation Day triggered a wave of say of rotation out of US assets into other assets. They are slowly returning because, well, we see the technological leaders are in the US. Well, what's your view for 2026? Will the rest of the world keep outperforming the US? Will we have a return of those investments back into the US?
My opinion is that you need to be exposed to developed economies. So when people ask me, should we be invested in the US or in Europe, they're completely different stories. No? The reason why you invest in Europe are, as we have seen in 2025, because companies that have limited levels of growth, limited levels of innovation, technology, and certainly those things that capture the minds of investors in the United States, but are doing very well in other areas. No, they're doing very well in terms of managing their portfolio, in terms of generating good margins in a challenging environment, and they're actually doing a good job of capital allocation. One of the things that tended to affect negatively European companies relative to US companies was that European large companies in the big indices were very M&A heavy. They tended to purchase growth from abroad at very, very high prices and then destroy value. And second is that the United States companies were buying back shares while the European companies were increasing capital, paying dividends in shares. No, so that generated a huge difference in terms of investor appetite. I think that European companies are not in an expansionary and inorganically expansionary phase, and that is a good thing. And they're also in a period in which banks, industrial companies, etc., don't need to maintain their dividend increase in capital, no? Which is a very good thing for investors as well. So those are elements that lead me to believe that it's still a good environment to look at European companies. But if you're looking for technology innovation, if you're looking for growth in and expansion of margins, you're still going to be looking at a handful, actually 25 to 30 companies in the United States at least. No, so I think that the age of US exceptionalism has not gone, to start with, because you just have to see the multiples. No, the S&P 500 multiples and the Nasdaq multiples continue to be significantly higher than those, and that is a proof of that exceptionalism. The second thing is that, as you very well said, the Liberation Day tantrum generated a flow out of US equities. But a lot of people now have started to see, particularly since July, I would say, have started to see that these companies are doing well, that companies like Walmart are not suffering from higher prices and lower margins, rather the opposite, no? All those things. So I think that those elements that have traditionally made US companies thrive continue to be there. The only thing is that you need to be selective, because it's not affecting 500 of the S&P 500 companies. It is affecting 100, 150 of their names. Same in the Russell 2000. Same in the Nasdaq. No, in the case, and in the Nasdaq, it's a lot less actually. And the same thing is happening in the European companies. That we need to be selective. We need to look at those that are going to continue to be in a very strong position of earnings growth, margin expansion, and improvement of sales. So what I always like to say, that I like to invest in Europe when I am, as an investor, in front of the cash flow and behind the capex. And I think that that's where we are. We are in a sweet spot for quite a few sectors in Europe that we continue to be positive on. So what it leads me is to think more of overweight developed markets, US, EU, than choose between the US and the European companies, because obviously if you want technology names, you're not going to find them or you're going to find very little in the European stocks. If you want, for example, renewable and energy transition leaders, you're going to find better options in Europe than in the United States. So I think that we're spoiled for choice to look for good investment opportunities in both areas.
You mentioned developed economies, also technology companies mostly favoring the US. If we look at the AI race, which is resembles the race to the moon in the 60s, we see that 50% of the data centers are built or being built in the US, about 25% China, and then Europe, and it's about 10% Japan 5. So what about China? Is it a blind spot now not to invest in Chinese equities? We know about investor protection. We know about what happened in 2020, 2021 with this wave of government intervention. What's your take there?
I think that the government learned from the 2020, 2021 intervention in the technology sector that it generated an enormous backlash against Chinese stocks. No, so I think that. First, on a macroeconomic level, I think that China, like the United States has surprised in 2025, I think that China will surprise in 2026 as well because of technology and investment in technology. No, I think that in terms of China, we need to be very aware that we cannot expect multiple expansion. So we need to be aware of the reality of the space and the level of intervention that the government has on companies. But and that the real estate bubble that is bursting in these years is far from over in terms of let's say eliminating and cleaning up the slack. No, so once you get away from the sectors that are too exposed to the exporting side and therefore will suffer from lower margins as they push to reduce prices, and from the real estate sector, in technology, in industry, you have, and in the financial sector, you have some opportunities that can be looked at in the Chinese market.
Yeah, I agree. You need to be very selective. We are still not allocating to Chinese equities, but we need to keep looking to what will be the next DeepSeek who could basically overtake the US. So it's even if you don't invest, you need to be actively monitoring what is going on there. So we end the reach of the end of the questions that we had planned for today. So let's look at some questions from the audience. So I have the first one would be, what would you recommend for an investment in euro currency for 2026? It's broad, so ETF, bond market, materials, etc.
In terms of investing in Europe and
euro currency, so that necessarily means euro, I would say, and then bond market, materials.
Okay.
ETFs.
Okay, I think that if we look at what is going on the fiscal side, it's going to be very challenging to reach the levels of returns that investors require in Europe with sovereign bonds. But you have very good options in terms of fixed income in high yield, for example. I think that high yield is going to lose the high very quickly because the companies are doing very well in terms of their cash flow. The companies are doing very well in terms of their balance sheet. And people are starting to see that it's a very good space in which the risk return is actually quite positive compared with sovereign bonds that are not going to give a real economic return. There may be opportunities with playing a little bit with the level, with the period, with the length of the bonds, no, with maturities, but not quite a lot. In terms of the sectors, I think that it's interesting to look at the industrial sector because so much already has been seen negatively, and rightly so, that I think that we can see a little bit of an improvement coming from opening up in terms of the trade agreements with the United States, opening up with with the increase in defense spending, etc. So industrials, materials could be interesting as well. And I think that everything that has to lead to the energy transition, the utility companies are still quite attractive. Um, and the only thing that I would be a little bit more not negative at all, but I think that you cannot expect the same level of returns from banks once you have had such a phenomenal and deserved run, considering the improvements in the core capital and improvements in their net interest margin. I don't think that there's much opportunity for banks to increase net interest margin into 2026, 27.
So again, the as we said at the beginning, this tide will lift all the boats in a sense. So European companies will benefit from technology and from growth. You mentioned as well increasing the maturities of the bonds, getting into longer duration, and that's something that makes sense. So long-term interest rates are at about 3%, and you mentioned before the ECB may restart cutting interest rates. So there is, as we call technically term premium, there is an incentive to get to longer maturities. That's something to look at in European equities. And as you mentioned, selectively pick your sectors, pick your companies. Probably Europe has been cheap from a valuation perspective for a long time, and now you need to be more selective and try to pick those companies that cannot perform, regardless of whether they are in Europe or not. So agreed. We have one more question. We will go to the other side, to the US dollar. What is your view or our view on the US dollar and its role as the global reserve currency?
Well, there is absolutely no question about the continued kingdom of the US dollar as the world reserve currency. We have the latest figures from the IMF, from the Bank of International Settlement, from SWIFT in all metrics, from reserves, from transactions, from bilateral transactions. The US dollar continues to be the king of currencies, and logically so, because of liquidity, transparency, and independent institutions, and legal and investor security. So there is very little risk there. What you cannot expect is that in a world in which what we are living is a gradual displacement, in which central banks are not adding sovereign debt to their asset base as much as they did in the past, and they're looking for gold. What you cannot expect is a radical change or radical moves in the US dollar as a relative to other fiat currencies, i.e., what we have seen is that we saw in 2024 how the yen and the euro went to lows, 40-year lows for the yen, 20-year lows for the euro. Then they bounced, but since July, basically the DXY index moves between 99 and 100, 99 and 100. It's basically moving in a very narrow range above the 5-year average, which tells you that the world is not abandoning the US dollar, but it is basically showing as well that we cannot expect a massive strengthening of the US dollar that will lead back the yen, the euro to 40, 20-year lows. No? So I think that the dollar is likely to remain, I always like to say, is the tallest short person in the room. The euro, the yen, the British pound are having enormous levels of fiscal challenges. Their central banks are not defending the currency, and therefore the term financial repression that was created by Rogoff and Reinhardt is very much evident. No, so the U.S. dollar remains the king out of a very small group of kingdoms that are losing in terms of purchasing power of their currencies, and that's why other central banks are buying gold into their asset base. No.
We will park that. You mentioned before the Liberation Day tantrum, and that also had a big impact on the US dollar. We were at the beginning of the year almost reaching the parity, and then we went close to 120. So now it's kind of normalizing. I will add to what you said before, from a fundamental perspective. So economic growth differentials will favor the dollar, as we mentioned before. The interest rate differentials probably will stay or even benefit the dollar. And there's an aspect of what happened in April, which is tariffs and trade deficits. Trade deficits will narrow in the US, and that should also be a positive for the US dollar. So from a fundamental perspective, also, one should expect, not a drastic change, as you mentioned, but to have at least limit the weakness, the US dollar weakness.
Yeah, I would certainly, I would certainly be very, very cautious about having a negative position on the U.S. dollar. Everybody, since June, July, every big crowded trade that had as a short side the U.S. dollar, be it Bitcoin, be it some of the technology names, etc., has worked horribly, and margin calls have done quite a bit. So I think that, on the one hand, all those things that you mentioned are very, very important. And I think that the other element that is very important is that now it's not a question of sort of philosophical debate, but now we know that the US is collecting an absolute record figure of tariff revenues, about 28 billion a month. And at the same time, that the inflationary pressures are very, very limited. So once those two things are out of the picture, then a lot of that, let's say, aggressive stance toward the US dollar have had to change.
You mentioned it has been a losing trade, shorting the dollar, with one exception, I would say, which is gold. And it leads to the next question we have from the audience. What is our outlook on gold? You mentioned before reserves. It's true that if you look at global reserves, the dollar has not lost any status. Actually, it's the euro and other currencies that have decreased. But obviously, you see now that gold has increased. Obviously, it's gold measured in US dollars, which creates this impression. What's your view on what has happened with gold? Because there has been a delay from the time gold should have been signing, which was 2022-23, with high inflation and still interest rates not going up. It came with the appreciation with a delay, and then we have had a tremendous rally for gold.
Yeah, I think that what really made the difference was the realization from investors that global central banks were reducing their exposure to sovereign debt in their asset base and buying aggressively gold. The Chinese central bank, the Omani, the Polish central bank, etc., buying as much. So what can we expect for 2026 on the side of central bank demand? The same. The central banks are going to continue to increase their purchases of gold because they have already announced it. So I think that is quite evident. Number two, from the supply side, it continues to be very limited. Supply of gold is very, very limited compared to the rise in demand. And from the monetary aspect, the appreciation of gold, as you rightly said, is having a delayed effect of the reduction in the purchasing power of fiat currencies, persistent inflation. No, as the environment of persistent inflation is likely to go on, although at a lower pace, as we mentioned prior. In 2026, it is very likely that gold will continue to perform well. Obviously, are we going to see gold go into 8,000? That's a different thing. That is obviously that it will have to do with a lot more avenues of let's say, of change in the monetary system. But I would count as with gold and silver playing the role in a portfolio that historically was played by sovereign bonds. Sovereign bonds used to be the driver of stability, returns in a weak market, etc. Gold and silver basically are playing the part of what central banks are actually doing, which is adding it to their asset base in order to have stability and in order to have less volatility. So I would say that 2026 is likely to be a good year for gold. And that does not mean, like it did not mean in 2025, that it's going to be a bad year for equities. It's a different story. Gold is a story of a change in the monetary system. The Chinese, instead of hoarding treasuries and euro bonds, they're hoarding gold, and there's a change in the way in which central banks create the stability of their balance sheet. Developed economies are buying more treasuries, Canada, the UK, France, etc., and emerging economies are buying more gold.
Definitely, the dollar has become a geopolitical tool, and it has a cost on the attractiveness of treasuries. We tend to see a bit different on the price of gold and the potential appreciation. I mean, just simply because, I mean, traditionally we have been it's an asset that makes sense in a portfolio for diversification purposes. It's a risk asset, so you cannot say it behaves like a bond, even though you see it as a store of value, like or central banks see it in that way. From a portfolio perspective, the question is whether this appreciation it came with a delay and probably has been an order or two orders of magnitude bigger than what is justified by the lost purchasing power. And so you need to count on a flow of investors buying on the margin. You mentioned central banks, which may be the case, but there has been also a lot of, in a way, speculative money flowing, and we have seen also the correction, the sharp appreciation and correction. So a word of caution there. In the long run, it has been an asset class that typically we have used in portfolios. It has become less predictable in terms of volatility and correlations. So that's something that we don't like. But so thank you very much, Daniel. We have reached the end of our Q&A session today. Thank you for your insights, and thank you to all the audience for participating. Also, we appreciate your questions, and we are looking forward to seeing you in our next edition of Market Talks. So have a great day, all of you.
Thank you so much.
Thank you.